faculty of the session, Sri Dhananjay Gokhale, the coordinator of the session, Sri Janish P. Parikh, seniors and friends, good afternoon everyone. I think it's the second half post-lunch session. So Dhananjay bhai sir, I think it's always difficult to give session, particularly when it's a post-lunch. And I was just going to on second floor, and then there are a few friends who offer ice cream. Then I thought, my God, ice cream is there. So it will be difficult to digest, and particularly when the topic is such, which is one of the most critical topic of bank audit, there's IREC norms. And these can completely change the way financials look like. And maximum MOCs, which if possible, is in IREC only. So I'm sure that people are on the way, and they all are eager to learn and understand about the IREC norms. Taking a couple of minutes here just so that by that time people will come and we can start. Friends, if you have been allotted the bank branch audit, you are the few luckiest persons in India. So first, feel proud that you have been allotted a bank branch audit. And as far as the future of ICAI or CA members to continuing get bank audit, it all depends on you. So responsibility on your shoulder is very high. And that's why we have to ensure that quality need to be addressed at the top and highest level. One of the very, very important things which I would like to mention, obviously maybe in the inaugural session it may be mentioned, is about the ICAI has issued a bank branch audit utility. How many of you are aware about that? Okay. So please go through that audit utility. It's an Excel-based audit utility. Yesterday there was a session organized by ICAI to give you a brief training about how can you use bank audit utility. Why we are all focusing on this utility reason is that we understand that the documentation is one of the most important part as far as the bank audit is concerned. And for every assurance job, now the biggest thing which everybody is concerned is about signing. And if your firm is covered in peer review, the files of bank audit ought to be selected as far as the peer review is concerned. And after 3 years, 4 years, if something happens, no one is going to help you because the branch manager is changed, staff is changed, everything is changed. For clients, probably they may help you and support you. But the bank audit staff is not going to help you anything. So whatever you collected at the time of the audit is the only document evidence with you. That's why please ensure that you plan it out well in such a fashion that you are having the document evidence available. So tomorrow, if any question comes to mind, we are able to sustain our claim. So there are very, very important utilities for audit is concerned. One is that there is an engagement letter utility is being released by ICAI. How many of you are about the engagement letter utility? Okay, very few, but see, engagement letter is the compulsory as far as any assurance engagement is concerned. For bank audit, NOC is important. So there are few cases where if you approach the earlier auditor, they may say to you, no, NOC is not required because it's allotted by the PSU by RBI. But NOC is also required as far as the bank audit is concerned. We need to get NOC from the previous auditor. Engagement letter, MRL, they all are applicable equally to every audit under bank branch audit. So my best wishes to all of you, and I'm sure that we will conduct bank audit in such a fashion that this will be going to a way where they are going to increase such a bank branch in the future. So all the best to you. Now I request Janish bhai to briefly introduce the faculty. Thank you.
Good afternoon, everyone. Today we have amongst us an eminent speaker, CA Dhananjay Gokhale sir. He is a founder partner of the firm Messrs. Dhananjay J. Gokhale and Company Chartered Accountants, specialized in providing management consultancy and auditing and assurance service in corporate and banking sector. He is a co-opted member of AASB and he is a special invitee of AASB in various years. He has authored many articles and authored various books regarding background material for Executive Master Program for New Age Auditors, ICAI Manual on Concurrent Audit of Banks, and so on. He has handled various assignments related to area of bank audits, including statutory central audits of PSB, merger and acquisition of urban cooperative banks, and consultant to CEO and board of the banks. He is regular speaker at various seminars on standard on auditing and bank audit across all the regions and various branches of the ICAI. With this brief intro, we welcome you, sir. Now I request CA Chintan Patel, sir, to felicitate Dhananjay, sir, with memento.
Good afternoon to all of you, and thank you for the introduction. And Chintan and myself have been multiple times on the dais for the same occasion, and I think the same topic, I suppose. And I don't know, how many times I have been speaking on this topic, but I presume that since you are inviting, you are still interested in listening to that. Because IRAC norms over the years have remained same, barring certain finer changes which RBI keeps on making. Fortunately, as compared to the last year, like earlier the circular was April 22, now the circular is April 23. In April 23 circular, practically nothing has got changed. So there is nothing like, something new which you have to learn. But at the same time, we need to polish our NPA norms in the sense what we perceive as, that has been done by the bank. So what I will try to do is that whenever I am showing a particular slide, I will be brief about the concept of NPA. I'll just, try to give more insight about how the softwares might be, having an error in that logic, for the simple reason that the software vendors or the software developers per se are neither bankers nor CAs. At times there might be certain ex-bankers who might be roped in by, the software vendors. But what I found out in last couple of years actually, to be very frank with you, is that many a times the accounting concept is not inbuilt in the software, which is mandatory. So what is perceived by RBI is from regulatory angle, and what we as a chartered accountant, we are certifying is the balance sheet and financial statements. So when we say about NPA norms or regulatory requirement, we need to also pay attention to whether the accounting treatment is correctly given or not. So one is about marking an account as NPA, since you are talking on this topic, and secondly, talking about how the accounting terms are adopted by that particular software or not. So I will just harp on those aspects more. And I think I needless to say to all of you, if any queries there, you can just interrupt me in between, and we can have a dialogue. I don't have to be that formal with all of you. I can see many familiar faces because over the years I've been interacting with you all. This is a brief coverage which I will try to make as much as possible. So 3 basic circulars which you need to have handy when you are talking about IRAC norms. First is the master circular issued on 1st April 2023. Then master directions are there which have been issued in October 2018, wherever the agriculture advances are there. There this circular will be applicable. And there is one more circular, that is transfer of loan exposure circular. This will be applicable only in those cases wherein either the portfolio is sold off or portfolio is bought from the other bank. Because nowadays actually multiple public sector banks are having different approaches for transfer of loans. There are certain specialized branches wherein such loans are parked in certain PSBs. In certain PSBs, it's in normal branches also certain loan portfolio might be getting parked, which is procured from the other bank. Maybe either on recourse basis or without recourse basis. Both are, prevalent terms. What you need to verify in this particular circular is that whenever a portfolio is transferred in your tenure, just ensure that the compliance with this circular is done by that particular bank or not. Secondly, there will be always a kind of a lag between the data which is getting, collected from the source bank to the bank which has sourced this or, bought these loans. So typically what is expected is that whenever you are marking an account as NPA, it has to be a, a regular and routine ongoing process. But in case of bought out, loan accounts are concerned, at times it might get delayed because the collecting bank is different and your bank is different. So there is no real-time basis, concept which will really apply. So that loan portfolio you need to deal with separately, and the other portfolio which is a regular portfolio where the lender is your own bank, that is your own branch, there the real-time, basis marking is possible. So just pay little attention to such cases wherein you are doing a specialized branch or a large branch wherein such portfolio is parked. Now, as far as objective is concerned, RBI is very clear in initial paragraphs itself that as far as classification norms are concerned, banks are required to follow objective criteria, and whichever criteria they are following, that has to be followed in a consistent manner. Now, when I am saying objectivity is required to be adhered into, it means that there is no scope for subjectivity. So there are popular beliefs that IRAC norms are not clear, there is ambiguity, there is a loophole. In reality, there is no such case, barring only one instance wherein inherent weakness is identified by the, the respective auditor. Because inherent weakness is something which you cannot define. It will be based on case-to-case basis, based on circumstantial evidences, based on operations of the account. You need to define as to whether a particular account is having an inherent weakness or not. So even system cannot capture that which are the accounts which are having inherent weakness. So there is a limitation about this concept or subjectivity about this concept, but as far as other concepts are concerned, RBI is very clear on that. There is no ambiguity which is really involved. Now, when you distinguish between two types of accounts, standard accounts and non-performing assets, the basic distinguishing factor is that these are the accounts wherein higher than normal banking risk is involved. So let's look at what is a normal banking risk. Since bankers or banks are into the business of lending and borrowing, there is an inherent risk which is always involved about the realization of that loan. So there is a chance that a particular borrower may not return back your money. So that's the inherent risk which is applicable to any lender, whether we as an individual we are lending to someone, or whether a NBFC is lending, or whether a bank is lending, the risk remains same. Whenever that risk parameter is breached in an adverse way, or wherever you feel that there is a risk which is involved, which is more than normal banking risk, then such accounts turns into NPA. Now, which are these risks and how to identify that? First is that RBI has defined certain criteria, typically popularly known as 90 days criteria. Now, even when we are talking loosely about 90 days criteria, the criteria are different for different types of loan. So, for example, for CCOD accounts, it is 90 days criteria. For all other facilities, it is more than 90 days. So, when you talk about marking of an account as NPA, for CCOD it is 90th day. For all other facilities, it is 91st day. So, popular belief is 90 days is the criteria, but in reality, it is 90 and 91 days criteria. Other parameters which are indicative of higher than normal banking risk is, let's take an example of a project loan. So in project loan, there is a DCCO which is defined, that is date of commencement of commercial operations. So what it indicates is, whenever you are giving a loan to an economic venture, and at that point of time, the banks are supposed to ensure that the DCCO is incorporated in the sanction letter itself. That is at the time of loan closure, loan sanction note closure, the date is required to be defined. Now what does this date indicate? It's an indicative date by which the borrower expects that the commercial operations in that particular economic venture will start off. So it's only an expectation, it's an estimated date. And there is no predefined criteria as to how many months should be given or how many years should be given. So usually what the bankers will do is that they will ask for the estimated date from the borrower. They will add some additional leverage to that. So suppose 15 months is expected, bankers might say that after 18 months DCCO is there. There is no bar on that. Only thing is that as an auditor, what we need to look at it is whether it is fairly justifiable or not. Means suppose that normally say 15 months, one should not give 30 months or 40 months criteria. That is something which is absurd. But otherwise DCCO is fairly definable date. It is the banker's call. Now once DCCO is defined, if that unit is not able to start the commercial operations, unless and until the DCCO is extended, which we will deal with in subsequent slides, then in that case, the account will straight away turn into an NPA category, even if overdues are not there. The reason being, since commercial operation has not started off on the estimated date, there is additional risk which is perceived. And whenever the commercial operations will start off, the account will get upgraded back to standard asset category, because the reason why that account was downgraded has been removed, because now the commercial operations have started off. So account will automatically get upgraded. So this is one example. Another example I can give is straight away classification norms, wherein if you are holding a particular security, and if you are doing a second valuation of that, in the sense maybe at the time of sanction you have done first valuation, maybe after 2 or 3 years you have gone back to do a revaluation of that. And in that second valuation, if there is a deterioration in value beyond 50%, then the norm which is stipulated is that in those cases, the bank has to revisit those standard accounts, even if it is a standard account. And if the bank feels that there is some unjustifiable reason, or if there is additional risk perceived, or if there is a fraudulent element involved, that account will straight away get classified into doubtful asset category. Now this testing of standard account is applicable for erosion of 50%. But let's take another case, that suppose it is a substandard account and there is a erosion. Then there is no test which is required to be carried out. It has to be simply downgraded to doubtful asset category without waiting for that 12 months period to get over. So these are few examples, wherein you might feel that there is additional risk involved. And the third example is that if as an auditor, if you feel that there is an inherent risk which is involved in a particular account, you need not have to wait for 90 days norms, and you can simply downgrade that account and mark that account as substandard account or maybe doubtful account also. Now those are the circumstances wherein as an auditor, you need to ensure that you are communicating your intention to mark that account as NPA on the basis of inherent weakness in clear terms to the branch manager. In the sense, since you are talking about branch, I am giving a reference of branch manager. So ensure that your documentations are correct. Give him an opportunity to represent before you as to why, according to the branch manager, there is no inherent weakness. A simple example of inherent weakness is, suppose you observe that throughout the year, a particular CCOD account is regularly overdrawn. So maybe in 90 days moving block, 85 days are always overdrawn, and 5 days somehow it has been managed to bring down within the limit. And even the source of fund is something which is little suspicious, in the sense there are round figures wherein the account is brought within the limit. So here you can invoke that criteria by saying that the overall conduct of the account is not good, and you can ask for the justification as to whether the income generation activity is really justifying this facility or not. And you need to harp upon income generation activity, because that is the only way to prove either way. Suppose there is an income generation activity, or if the source is from the business income or business receipts, you can very well presume that it is regularized in the normal way. Welcome, Ketan. And after this slide, now we will go one by one about different types of account, and at each level I will just keep on referring to particular software lacunas without naming any software for obvious reasons. But I'm sure that many of you will, can be, easily gauge those softwares, because almost all leading softwares are having certain lacunas, and the real reason is that the accounting factor is not factored into that. So maybe in few, maybe 1 or 2 years they might factor in, but till that time we have ample scope to play around with that. So let's start with the term loan. Now the term loan, the criteria is that if the installment or interest or principal, if it remains overdue for a period of more than 90 days, the account will turn into NPA. So 91st day you have to mark that account as NPA. So let's go step by step. Firstly, this criteria is applicable only when that term loan account is overdue. So let's presume that if the term loan account is not overdue, the account can never turn into NPA. Second important thing is that here we are talking about overdue and not realization. So realization concept is nowhere there in the picture in NPA norms. It comes after we mark that account as NPA, which we'll deal it separately. Now let's look at different types of term loan accounts. So first term loan account is the regular one, EMI based payment. Second one might be interest as and when, and principal remains constant. Third one might be, there might be a ballooning. So initial installments are lower and later on they will go on increasing based on projected turnover or projected profits. There might be an instance wherein moratorium period is given. Moratorium also can be given in multiple ways. One simplest method is that in initial period, bank might say that principal repayment there is a moratorium, but interest is as and when. Certain banks might give you a loan wherein even the interest might get capitalized as a part of sanction letter itself. Typically housing loan, which is wherein the property is under construction. So maybe first 1 year the bank will say that there is a moratorium period for interest which will get capitalized. So out of say 100 rupees, maybe 95 rupees are disbursed, 5 rupees interest gets capitalized. After 1 year, based on 100 rupees principal, the repayment will start off. Now the difference between these two is, or the earlier criteria is that here the interest is getting capitalized as a conscious call. So it is not FITL. There is no funding. It's a limit which is already sanctioned. And the difference between FITL and this facility is that in FITL, the interest is already recognized, in the sense it is already accrued, and then we are carving it out and creating a separate facility. In this instance, there is nothing like FITL or a separate facility which is carved out. The interest is capitalized as a part of sanction process. So that is the difference between these two. Now how the overdue is defined is, RBI circular defines what is meant by overdue. So wherever the amount is due to the bank based on the schedule of repayment which is conveyed by bank to the borrower, if that is not followed, then overdue concept will be there. So let's take a simple example. Let's presume that every 10th of every month the EMI is due. So on 10th, if I don't pay EMI, at the end of the day of 10th, my account will be overdue. So 10th is my first day. So like that I need to count 90 days, and after 90 days, 91st day I need to mark that account as NPA. Now where the flaws might be there in the software. Firstly, we need to calculate the overdue component. Now how to calculate overdue component is, let me give a simple example. What RBI stipulated is, RBI stipulated that whenever a loan is sanctioned, the repayment schedule has to be given to the borrower. That is a mandate which is there and which is invariably not followed by most of the banks. So, first thing is that you need to ask them that whether the repayment schedule is conveyed to that borrower or not and where is the evidence for that. So, firstly, repayment chart has to be there. Now, what is the use of this repayment chart? This is an indicative repayment schedule wherein it is presumed that the particular borrower will be repaying that installment exactly on the due date. So, based on that presumption, it is an ideal ledger account. So, the exact amount will be paid exactly on 10th of the day, and that's how the interest and principal breakup will be there, and the account will get nullified at the end of the tenure. That's how it looks like. In reality, what will happen is the borrower may not pay exactly on 10 day. He might pay little earlier or maybe little later. Now both these things will have impact on your actual ledger account. So how to compare this is, you need to compare your ledger balance with this ideal drawing power calendar or ideal ledger balance on a particular day. So suppose you are, today you want to test an account for overdue. So today is 15th. So 15th ideal ledger balance you need to take, compare that with 15th actual ledger balance. If there is adversity, that is your ledger balance is more than ideal DP, the difference is your overdue component. Once you get the overdue, go back to the demand schedule. Like suppose your overdue is say 25,000 and your EMI is say 10,000. Go backwards. So your 3 installments are overdue because 2.5 third installment is overdue. So once you go backward, probably 10th March is the first one, 10th February, 10th January. So from 10th January till date, these are the number of days your account is overdue. So that's how you need to calculate that. Now let's get little into complexities of that. It might happen that there might be insurance charges which are debited, there might be notice charges which are debited. So those are immediately due. So on whichever date they are debited in the account, they are supposed to be paid on the same date. So I'm getting little finer into that. Now how the software takes care of that? Firstly, the software should have a capability to have that demand calendar static in the system unless and until there is a change in rate of interest. Most of the softwares don't have this repayment calendar which is generated through the system. So first ask that whether the repayment calendar is available or not and whether it is static or not. Now let me give an example about why that staticness has, is getting compromised in most of the cases. I think Kuntal already gave few of those examples, but let me go more into detail into that. So let's presume that on 10th, 10,000 rupees is due and that borrower has paid it on say 15th. So when he pays on 15th, there are 2 additional interest components which are over and above the normal EMI interest. One is the additional interest for that 5 days period because 10,000 you have delayed. So let's presume that rate of interest is a 9%. So for 5 days at the rate of 9% additional interest is there as compared to ideal interest. So that is one component. Second component is since you have delayed it, there is a penal interest. So on 10,000 rupees that penal interest will get levied. So this additional interest is on entire amount. Penal interest is on that 10,000 rupees amount which is additional 1%, 2% depending upon the bank's terms. So let's presume that penal interest is say 100 rupees and regular interest is say 200 rupees. So ideally what the borrower is supposed to pay on 15th is 10,000 rupees plus 200 plus 100. That is 10,300. If he doesn't pay that, he is into default to that extent, right? Now many softwares are having a different behavior about acknowledging that 200 and 100. So let me give one example. One of the software, what it does is, as far as penal interest is concerned, it creates a demand. So as per the software, the demand is 10,000 plus 100. 200 rupees component, that is additional interest, what it does is it adjusts in the EMI itself. So let's presume that EMI composition is say 9,000 and 1,000, that is 9,000 principal and 1,000 interest. So that 200 is clubbed into that. So 1,000 becomes 1,200 and that principal component 9,000, it is reduced to 8,800. Now what happens with that balance 200, because now principal you are recovered to, lesser to that extent. That 200 rupees are pushed at the end and at the end of the tenure, the entire amount is ballooned. So that's how your repayment schedule undergoes a change. Like going by simple RBI circular logic, restructuring is nothing but wherever you are giving him an extension to repay any amount. So there is a relaxation which is given to a particular account, it amounts to restructuring. The moment there is a restructuring, account is required to be downgraded, which the system doesn't do. Because system doesn't even presume that this is a restructuring. So what happens in these cases is, the EMI repayment chart itself keeps on changing, depending upon when that borrower is paying that. So the moment he delays that, there is a additional amount which is created at the end. So that's why I said that just test the software whether the repayment calendar is static or not. If it is not static, there is something wrong with the concept itself. So this is first point. Let's come to the second point. Let's take a case that wherein advance installments are paid. So let's presume that in the month of October, 12 installments are paid. So 10,000 into 12, 1.20 lakhs is received in the month of October. Now different banks are having different practices and sanction terms. So let's first look at what are the practices are there. Some banks have a practice wherein this amount will be kept in a suspense account, that is a liability will be created, and exactly on the 10th, 10,000 rupees will be taken. So it becomes a CASA account. It's only a non-interest earning deposit account, no interest benefit is given to the borrower. That is one way to look at that, provided sanction letter specifies this condition. Second possibility is that there are banks which say that you can prepay, but then when you prepay it, we will either change your EMI or we will change your tenure. So there is an option which is given, you have to choose one of the option. But there is a third criteria also, that the borrower might say that I don't want to change EMI, I don't want to change tenure, I just want to pay a lump sum amount in advance. So I want all other conditions to be remaining same, which is also permissible and which is a banking practice. Rather, this is the most common banking practice. Now in that case, what will happen is, let's presume that 12 installments are paid in the month of October, and after that for 12 months, that borrower doesn't pay anything. So ideally till next September, he is even not supposed to pay anything because he has paid all that obligation in advance. So in the month of March, there will be 6 interest debits which will appear in the account, right? But there is no credit which is appearing against that, but still the account is standard because he has paid in advance. So his ledger balance is below his ideal DP. The moment the ledger balance is below ideal DP, the account is not overdue. If the account is not overdue, the account will be never marked as NPA. Interest is unrealized, but it is not overdue because overdue is the amount and not interest. So that is a distinguishing factor. Now, let's go further. So let's presume that till September also he doesn't pay. After September, naturally he has to pay, but still he is not paying. So somewhere in the month of January, the account will turn into NPA. That is 15th or 16th month. When that account is marked as NPA, then the subsequent conditions are required to be invoked. The subsequent condition or subsequent stipulation is that once an account is marked as NPA, you need to reverse the income which is not realized. So here the accounting concept will prevail. The accounting concept is that whenever the interest is debited in the account, that demand or that realization will be only based on subsequent credits which are there in the account. You cannot use your earlier credits to satisfy subsequent interest which is debited unless and until if a bank accounts for that as an advance interest received. So bank doesn't account for that. Bank has already adjusted 1.20 lakhs, the advance amount is already reduced. So the principal amount is already paid off. So interest realization will not occur based on that 1.20 lakhs. So when you mark that account as NPA on 15th or 16th month, the entire component of 15-16 months interest will be required to be reversed because it is not realized. Now let's look at how the softwares behave. In most of the softwares, they have a concept that this amount which is received in advance, they have a virtual concept that this is an overflow. Or just to put it in simple word, it is advance received. Nomenclature is not really relevant. Now this advance received, they presume that using this advance, the interest is getting serviced. Now if you test it, from accounting perspective, whenever any interest is received to you in advance, you need to create that liability against that. Like suppose you have received, let's take a cutoff of say March. So as on March, you are presuming that next 6 months interest is also received to you. That is from April to September. So suppose it is 1,000 rupees. So ideally you need to account for as 6,000 as your liability. That it is future interest which you have received in advance. But that is not done in the software. Or rather to go little further, even this overflow amount or prepaid amount is also not captured anywhere. So it's only available as on that date. So suppose today I want to go backward and if I ask a question that what was the overflow amount as on say 31st December, the data itself is not available because it is already adjusted. So it doesn't exist. So it's only a virtual concept. There is no accounting which really happens. So wherever you are looking at any account wherein the NPA marking is done, just look at the interest realization concept, whether it is properly adopted by that software or not. If not, you are supposed to qualify your report for the simple reason it is a regulatory violation. Because it indicates that IRAC norms are not system driven. Because IRAC includes everything, income recognition, asset classification and provision. So either of the three, if it is breached, it means that there is a manual intervention required or it is going wrong. So just look at those scenarios in a little critical manner. Now let me tell you one more thing. The way the adjustment of amounts received is done by certain softwares is also a little different. So let me give you an example. Let's not even get into NPA criteria. Let's presume that 2 installments are overdue. Again, like say 10,000 rupees, same case, 9 plus 1, 9 plus 1. And you have received 15,000. Okay, now 15,000 when it is received, or let's take a little different, let's say 5,000 rupees are received. Let's not get into 15. And suppose I ask you a question that say 2 installments are overdue, like say 10 January, 10th February, and say 10th March. So 3 installments are overdue. And 5,000 rupees are received, maybe today on say 15th of March. So will there be any interest which is not realized? So the composition is 9 plus 1 in January, 9 plus 1 in February, 9 plus 1 in March. So there are 3 amounts of interest which are debited in the account. After that 5,000 rupees is received. So if you look at the ledger account, you will say that against 3,000 subsequent credit is there, it is realized. But software behavior is different. The software behaves in a little different way. When 5,000 rupees is received, first it will adjust 1,000 rupees of January, which is the interest. Then 4,000 will be adjusted against 9,000 rupees of principal in January. Because that concept is related to demand flow. Now flow of demand or flow related to overdue is little different than realization concept. So that's where the hitch is. Unrealized interest, that field or that calculation is missed out by most of the softwares. So just look at it carefully as to how the demand adjustment is done and whether it is really in sync with accounting or not. If that accounting is required to be adopted, then that advance received and all other accounting terms should be there. If not, then what we are doing as a plain vanilla accounting should exist. There will be a lot of resistance which you will face the moment you raise this question. They will say that for all banks, this is the practice and all those things. Just ask them a simple question that let's take this account in manual days and tell us that how you were accounting for interest unrealized. And the answer is what we really want from their side. Because in manual days, this is how the accounting was done. That wherever there is an interest debit, subsequent credit, first we will adjust against the interest and then we will say that whatever is balance, that is unrealized. So that is the accounting term. So just go little deeper into that, because IRAC norms otherwise are adopted by most of the CBS systems now. Now where the hitch or where the issues are related to accounting terms. So just go deeper into that and you will get ample of queries related to that. Then another one is that whenever you are talking about this reversal of interest, wherever the interest is getting capitalized, the example of housing loan which I gave, that during the construction period, the funding is already pre-sanctioned. Then in those cases, whenever the interest is reversed, then that interest component is not required to be reversed because it is in sanction term. So it's not FITL, so that remains as it is, and subsequent to that only, whichever interest is component is remaining unserviced, that will get reversed. Then as far as demand calendar is concerned, we already talked about that. Overdue, unrealized, we already talked. These are just bullet points which I thought that I will just add it over here. Now, as far as staff advances are concerned, in case if your branch is having a staff advance, just inquire with them whether the staff advance related NPA criteria, whether they are system driven or whether they are manually driven. Because the terms of sanction for staff advances is different. Typically in most of the banks, first principal is recovered, then interest is recovered. So at times the CBS system may not be able to take care of such dynamic concept of staff advances. So just inquire about that and based on that decide your audit strategy, because it may be having a manual control. Then as far as bill purchase and bill discounting is concerned, normal 90 days, more than 90 days criteria is adopted. Now let me give you a couple of examples over here. See, first thing is that as all of you are aware about that, whenever a particular account is marked as NPA, all other relational accounts are also marked as NPA, right? So suppose I mark a housing loan as a NPA, and if I am having a vehicle loan, even if vehicle loan is paid in advance also, that will get marked as NPA. Now this criteria doesn't get extended to LC-BD facilities, wherein the LC issuing bank is other than your bank. So suppose you are doing an audit of SBI and Bank of India LC is discounted by the borrower, and if other accounts turn into NPA, then this account remains standard because the exposure is on Bank of India, not on the borrower. So in LC-BD, that is the only exception which is carved out. But that concept will not apply if SBI LC gets discounted, because SBI cannot have exposure on its own. So the exposure will be always on the borrower. So this is one exception. In case if you find out such cases, just check that whether it is a manual driven control or whether it is system based control. The challenge is that in most of the CBS, there is no field to capture which LC is discounted. Because unless and until you have that field, you cannot capture this LCBD concept. So that is one thing. Second thing is that in case of LCBD facilities, the vice versa rule will not apply, because suppose LCBD fails. Just to give an example, couple of years back, Punjab and Maharashtra Cooperative Bank failed. So their LCs which were discounted, those banks, those accounts turned into NPA. Now in that case, the exposure, even if it was on the bank, parallelly it will also be presumed to be on the borrower, and other accounts of that borrower will be also required to be marked as NPA. So it's not vice versa, it's one way. So LCBD is exempted, but if LCBD gets marked as NPA, these accounts will also turn into NPA. Now there might be a clean bill discounting wherein there is no LC backing. If such accounts are marked as NPA, the normal criteria will get adopted. Now one more thing over here, suppose bill discounting facility gets marked as NPA, as far as income reversal is concerned, you need to be little critical. Because in almost all the banks, the practice is that the interest is recovered upfront. So suppose say 100 rupees is a discounted amount and say 5 rupees is the interest, 95 rupees are given to the that current account or CCOD account, and 100 rupees is the bill discounting component. Now that 5 rupees is not supposed to be considered as realized. It's only accounting entry which we have passed. We are just recovering or keeping that portion aside. There is no realization of that. So the entire component of commission or discount, whatever we call it, that will be required to be reversed. Then as far as agriculture advances are concerned, the installment or interest criteria, that will get replaced by crop seasons. So if it is a short duration crop, 2 crop seasons will be replacing that 90 days criteria. For long duration crop, it will be 1 crop season. The definition of short and long duration crop is up to 12 months and more than 12 months. Now as far as these agriculture advances are concerned, the challenge in agriculture advances is that it is not a system driven process. The reason being, presuming that it has to be a system driven process, for every agriculture advance, you need to feed in the crop seasons at every yearly intervals. And you need to keep on reconfirming that. Because otherwise system cannot decide as to when to mark that account as NPA. Now most common error which is found out in case of agriculture advances is about the interest application. The interest application criteria which RBI has defined it is based on crop season. Now it is not that easy to say that the interest can be applied on the crop season unless and until crop season are fed in the system. So there might be a case where in one crop season is 8 months, the other borrower is having a crop season of 15 months. So the interest will be always accrued but not due till that date, and then only it will be required to be capitalized. But what we look at in reality is that it's either on monthly or half yearly basis, depending upon how the bank has structured. So just go a little deeper into that and ask this question based on RBI circular itself, that whether the interest frequency is correct or not, and on what basis you have compounded that interest, because even that is prohibited for agriculture advances. Now as far as agriculture advances are concerned, there is a concession given for reschedulement wherever the natural calamities have taken place. So as far as natural calamity definition is concerned, that is adequately given in the circular. But what is most important is that whenever such benefit is is extended, you need to first test check or first to test that whether that advance is the agriculture advance or not. In the sense whether it is covered in the definition of farm credit. Any advance given to a farmer is not presumed to be a farm credit. The end use is important. Now let me tell you where the Pandora's box is. See, if you look at most of the banks, there will be AGL, which will be the most common product, agriculture gold advance. It is always given under the pretext that RBI has given a relaxation that end use may not be insisted upon. But RBI nowhere says that end use should not be monitored. It's only a question of what kind of evidence you gather. Now, if there is a habitual case wherein on year basis there is a AGL which is given, which is just renewed, there is no movement in that account. At the same time, the bank is not even able to produce before you any circumstantial evidence that farming activity is taking place. Then in that case, you can question that whether this is agriculture advance or not. Now it has a bigger ramification. Every AGL which is given, if it is a real AGL, then it is under priority sector. But if it is a pure gold loan, you can say that it is a consumer or consumption loan, and every consumption loan may not be categorized as PSL. And there are PSL targets. I don't have to even spell out about PSL targets, which are very steep and they are not easy to even achieve. So just pay attention to AGLs especially. As far as KCCs and other cases are concerned, there are multiple concessions which RBI has given. One of the popular belief is that you have to entirely close that KCC account, but there is a counter argument. One can say that there is a produce which is there, crop produce, which is yet to be sold off. So the KCC is not closed and it will just keep on revolving on a year basis. Now the challenge over here is, it's very difficult to identify that which are the genuine cases and which are the cases wherein it's used as a continuous CCOD facility. Now what you can harp upon is just look at the audit sanction documentation which the branch is maintaining. Suppose you come across documentation wherein visits are there, some evidence is maybe either created or kept in the file. At least you can get satisfied that there is something which has been done by the branch. But if the entire file is blank, full of blank papers, full of blank AODs, then you need to be little critical about that and you need to report that by saying that there is no monitoring which is done. Then as far as natural calamities are concerned, there is a delegated power authority which RBI has mandated to, for the banks to ensure that quickly the banks will step into the action and the concessions are extended. Now there are two types of concessions which are possible. One is for short-term agriculture loan, second one is for long-term agriculture loan, and there is a difference in that. Now when we talk about short-term agriculture loan, the basic condition is that at the time of happening of natural calamity, the account should not have any overdue component. So only in those cases, there is an extension period which is possible. Now the extension period is again based on crop loss. So if the crop loss is between 33 and 50%, 2 years extension is possible. If it is more than 50%, you can have 5 years extension, inclusive of moratorium period of 1 year. And that moratorium can be interest, principal, everything. So for next 1 year, he doesn't have to pay anything. That's the popular model which is typically followed. But as compared to that, if it is a long-term agriculture loan, even if the account is overdue, presuming that the account is not a NP account, it is a standard account, then you can do an extension without any hitch. So both these conditions, what it means to say is, the reschedulement is possible without downgrading. So in first case, what we were talking about was short-term agriculture loan. The account should be standard and non-overdue, then only it is eligible. But suppose a short-term loan is overdue and it is restructured, that is the extension is given, then it will be required to be downgraded. But in case of long-term, it has to be only a standard account, but you can do all kind of reschedulement against that. Multiple reschedulement is possible in case of agriculture advances, so there is no downgrading which is required. So it can be every year also, presuming that every year there is a natural calamity. So it can go endlessly, to any extent, because every year it can get extended to one moratorium period, 1 year moratorium plus say 3 years or 4 years. Now, what precaution you need to take is, whenever there is any subsidy received, whenever there is an insurance proceed received, you need to ensure that that gets adjusted against that respective loan and not against the current dues. Because it might happen that your old loan, that is the earlier loan, has been given 1 year moratorium period and it is extended, and there is a new loan which is given, and whenever the insurance proceeds are received, those are adjusted against the current dues. So that is something which is required to be avoided. Those are required to be adjusted against the loan which is getting affected. Then as far as derivative transactions are concerned, the same 90 days criteria is there. Let me give you a typical example where this criteria will apply. If you happen to do an overseas branch or a branch wherein foreign currency transactions are there, typically in those cases there might be currency swaps, there might be interest swaps. Only in those cases these derivative transactions will be there. But nowadays actually since last many years the derivative transactions have reduced drastically, because if you ask me 10 years back, the bankers were mis-selling these products to many exporters and importers. But now everyone has got little educated, I should say, and derivative products have reduced drastically. So it will be a rare scenario to see. But if you are doing an overseas branch, derivative products will be in existence. Any liquidity facility, if it is extended, same 90 days criteria is there. In case if the credit card dues are there, presuming that there is no subsidiary entity which is handling credit card business and the bank on its own is handling that, so that is a presumption. So in that case, if the minimum amount due is not paid within 90 days from the next credit card cycle, then only the account will turn into NPA. Now there is one interesting part is there. So wherever there is a default made in repayment of credit card dues, if it is within 3 days, it is not presumed to be considered as default. So suppose you are having your own credit card which is due on 25th, if you pay by 28th, there is no default, no interest, no charges, no information to CIC is passed on. So that is a concession which is given. And IRAC norms are related only to the minimum amount due, which is typically 8 to 10% or maybe 12%, depending upon the card issuing agency. Then let's come to cash credit account. As far as cash credit account is concerned, this account will be marked as NPA if it is out of order. Now there are three criteria which are given to say that a particular account is out of order. If either of the condition is satisfied, the account will turn into NPA. And while explaining each and every condition, I will also tell you which are the controversial issues related to that. Let's start with the first one, which is apparently very simple. If the outstanding amount in that particular account, if it is continuously in excess of sanction limit or DP, whichever is lower, for a period of 90 days, then the account will turn into NPA on 90th day. So just to give a simple example, suppose my limit is 1 lakh and presuming that DP is also 1 lakh, if my account is continuously above 1 lakh at the end of the day of every day, for a period of 90 days, my account will turn into NPA. It's a simple condition to follow, simple condition to identify also. Let's get into little controversies. Now this limit or DP, whichever is lower, is the concept. So it might happen that every month you may not have DP which is sufficient to take care of your limit. So suppose 1 lakh is the limit and in a particular month the DP is 90,000 and the borrower has submitted the stock statement on say 15th of subsequent month. Now the issue is from which date that DP should be made applicable and whether the software is equipped to take care of that or not. Because a bank might take a stand that on 15th the stock statement is submitted, so I will go prospectively. So 1 to 15 it will be 1 lakh, 16 or 15 onwards it will be 90,000. According to me, my personal view is that the DP is always based on last month's stock statement. So whatever is the stock statement, that should be made applicable from first till that next month end, irrespective of whichever date he submits, because otherwise he can play around with that. Like suppose I am a borrower and my amount is between 90,000 and 1 lakh, in that subsequent period. I will submit my statement on 28th. So for 1 to 20th my account is regular. My account will never get identified as NPA. So first check up whether the CBS system is capable to take care of these scenarios or not, because otherwise 90 days criteria will never be fulfilled. Because the borrower will simply play around with that concept. Now second thing is that the second condition is if there are no credits in the account for a continuous period of 90 days, the account will get marked as NPA. Now all these conditions you have to check at every end of the day. It's not year end as it was earlier 3 years back. Now no credits in the account for 90 days, where the controversies will evolve. If it is a regular account, you can easily identify. If there are no credits, you have to identify. Let's take a case wherein in last 90 days, 87 days the account is in credit and for 3 days the account is in debit. Which can happen. He is having an adverse balance for 87 days, then he has issued a check and then 90 days are over now. So in that case also the account will turn into NPA because RBI has never exempted any account which is having an adverse balance in 90 days. The reason why this criteria is there is, this second and third criteria is basically to demonstrate that there is some income generation activity which is going on in CCOD account. It is not talking about adverse balance or overdrawn. The second and third conditions are categorically specified that even if your account is within limit, this condition should be satisfied. An account within limit includes adverse balances. There is no exemption which is given. So that's where, at times even if the account is good, the account might turn into NPA. Then the third one, if the credits in the account are not sufficient to cover the interest debited in the account. Now read those wordings carefully. The word used is cover and not realized. So in 90 days block, and 90 day will be, suppose today is 15th, 15th is 90 day and I have to go backward. So typically say 15th or 16th December till this 15th March you need to calculate. Now the simple method to calculate that is you need to take a summation of interest debited, compare that with credit summation. If credit summation is more, the account is PA, otherwise it is NPA. Once that account is marked as NPA, to calculate the unrealized interest, you have to apply accounting terms. So now let me tell you how the logics might go wrong. So let's presume that every month 10,000 rupees is the interest. And let's take the same block 15 December to 15 March. So on 20th of December, there is a credit of 25,000. So against 30, there is 25,000, so the account is NPA. So far, there will not be any argument actually. Later on, you need to find out that once the account is marked as NPA, reversal of income will apply. Now, reversal of income will be the entire component of 30,000 because there is no subsequent credit which is there. So, December, January, February interest will be required to be reversed. In some softwares, what they do is, they call it as a look back period. So, in look back period, they do a net of credit and debits. So in this case, against 30,000, the software will presume that 25,000 interest is realized, even though the credit is prior to interest debits, and only 5,000 rupees will be identified as interest unrealized. So to that extent, your accounting will go wrong. So just pay little attention that in case of CCOD accounts, wherever the account is marked as NPA, just see that how the system is calculating unrealized interest. Now let me add you a couple of points. In most of the CBS, when RBI has mandated that IRAC norms are required to be system driven, in most of the CBS, they are system driven only to the extent of marking an account as NPA. And provisioning, there are separate softwares. So for provisioning as well as interest reversal or recognition, that component may not be inbuilt in the system. So ask this question categorically to the bank, that your provisioning, whether it is taken care through system or whether there is a separate software. Because RBI nowhere is saying that provision should be separately done. So that's where possibly the errors might happen in such cases. So these examples we already talked about earlier. Now one more thing, that wherever there are relational NPAs which are getting marked, especially with the second and third condition. So the account is within limit, no credits in the account, or maybe shortfall of credit is there, and there is another term loan account wherein one installment is overdue. So the deposit, the borrower might deposit certain lump sum amount in that account, so NPA criteria is extinguished. But because other account is having some overdues in that, the account will still remain into NPA category. The account cannot be upgraded to PA category. Then as far as automation of IRAC norms is concerned, this is only a circular for your reference. I will not get into deeper into that because almost all the points which we discussed, but just refer to that September 20 guideline. It talks a lot about what is expected from the bank, including availability of test environment for the central auditors, which most of the software vendors are not providing. Even if RBI is saying that in their circular in black and white. The reason is that when you talk about test environment, it needs to cover the entire life cycle of that advance, which is typically 5 years. And the challenge is that you cannot keep on doing end of the day. EODs are not batch processed. So that's where there are inherent limitations. But just go through that circular just to understand that what is expected out of bank audit, statutory auditors. So I will not get into deeper into that because this circular is for CSS to be more specific. Now let's come to the part about temporary deficiencies which RBI is defining. There are two types of temporary deficiencies which RBI has defined. One is non-submission of stock statement and second one is non-renewal. Let's look at first criteria of non-submission of stock statement. What RBI has defined is, in case of large borrower accounts, you can make use of his stock statement based DP for subsequent 90 days period. So suppose September is the stock statement, whatever is the DP, if I don't submit the stock statement subsequently, I can make use of that for October, November and December. Later on I cannot make use of that, so account will ideally turn into NPA in the month of March because there is no DP available. But this facility or relaxation I should say, it is given only for large borrower accounts, and large borrower is not defined by RBI. So ideally the bank should define that what is large borrower and accordingly they need to adopt. But an account having say a limit of 5 lakh, 10 lakh by any stage of imagination, it cannot be a large borrower account. Means we can debate about 5 crores, 10 crores or something material in that. But otherwise this concession is not really extended for all accounts. Otherwise they would have simply said that you can use your DP for next 90 days. There is no large borrower word which is required. So the word is very specific. The second criteria is that in case of non-renewal or non-regularization of limits for 180 days, the account will turn into NPA. Now let's look at it from two angles. One is non-renewal cases. So wherever the original renewal date is there, if it is not regularly renewed for 180 days, the account will turn into NPA. So there might be short reviews, technical reviews which might take place which should be ignored. It has to be a full-fledged renewal which should happen. And irrespective of credit policy of the bank, 180 days are static. There are some banks which allow 3 short reviews. Now short reviews can be done even for NPA accounts. So credit policy delegation of power is something different than IRAC norms. IRAC norms are there for marking an account as PA NPA. Delegation of power is for running that account, which might be applicable for NPA also. There is no rule that substandard account cannot run a CCOD account. So even regular renewals are possible for NPA. So is the case with short renewals. As far as ad hoc limits are concerned, if ad hoc limits are not regularized within 180 days, the account will turn into NPA. Now, those of you who are also doing UCB audits, Urban Cooperative Bank audits, just switch after 15th April because 180 days norms in UCBs is 90 days. So don't, continue your 180 days criteria in UCBs. And they will be more than happy for that. But that is a distinguishing factor. Otherwise, whatever we were talking till now, it applies uniformly. I don't know for what it is, from 180 days it has been made as a stricter thing, but that's the difference in that. Just keep that thing in your mind. So don't mix up those two things. It can happen vice versa also. Throughout the year, if you are doing UCB audit, you might get into public sector bank and say that mark that account on 91st day. So that shouldn't happen. Then some exceptions which RBI has given, that wherever the loan is sanctioned against the underlying security of NSE, IVP, KVP, life insurance policies, the account will not be marked as NPA till the time security value, that is a realizable value, is more than your ledger outstanding balance. Now here there is a hitch. The hitch is that what RBI says is, the moment your balance reaches to that security value level, then interest should not be applied in the account. Now this is something which CBS system should take care of. So in case if you come across such account, just see that whether such conditions are fulfilled or not. Now as far as such accounts are concerned, wherever these accounts are relational NPA accounts, or some vehicle loan is marked as NPA, then this account will not get marked as NPA because it is completely exempted till the time it is not crossing that security value. Then where are the challenges? The challenges are that in some cases there will be a matured FD and the account is just lying as it is without renewal. In those cases, you need to inquire with the bank as to for what reasons, even after the FD has got matured, why that OD facility or maybe a loan facility is not closed. There has to be a reason for that. You cannot simply keep on accumulating your plus 1% interest on that till the time it is not reaching to that security value. In case of auto renewals, the loans are never auto renewed. FDs can be auto renewed. There is no system wherein loan can be auto renewed. So just pay attention to that concept as to how the CBS system is handling. Whether the CBS system is restricting that renewals or maturity date of that loan only to the extent of the earliest maturity date of that particular FD or not. Then in case of central government guaranteed accounts, they are totally exempted from NPA criteria. But if they are fulfilling NPA criteria, even though they are standard accounts, the income realization or income recognition concept will be on cash basis. Just to add one more thing over here, the central government criteria, there has to be a field in the master data, wherein there has to be a toggle, central government guarantee, yes, no. In most of the CBS system, this field itself is not there. So it is manually controlled. So in case if you happen to come across a case wherein there is a central government guarantee, even if it is a regular account, just ask them one question, where this master data is fed. If there is no master data field, system cannot work. So add that in your LFR and your main audit report that central government guaranteed accounts are manually handled. So, that's where the manual intervention will be there. Then as far as advances against gold ornaments and government securities are concerned, they are not exempted. And there are certain additional criteria are there, especially for gold ornaments. As far as gold ornaments are concerned, firstly, as far as bullet payment is concerned, for commercial banks, the upper limit which was there, that has been abolished. So they can give any amount of bullet loan. For UCBs, it is 2 lakhs, and it is still 2 lakhs. And the criteria for number of the number of installments or period or tenure for that term loan is also restricted to 12 months. Now, where the challenge is here? Firstly, there has to be LTV ratio of 75%, which is required to be maintained. So firstly, the CBS system should be capable to handle this portfolio, wherein by a single click, all the valuation will change. That is first thing. Second thing is that wherever that 75% is breached, that account will turn into NPA. So you need to monitor these accounts very critically. And the third one which we talked about was about whether the end use is non-agricultural or whether it is agricultural. Because based on that, everything will, things will undergo change. Let me add one more point related to agriculture and non-agricultural. See, typically in most of the banks, for agricultural loans, the documentations are different as compared to normal loans. So just see that which documentation set is executed by the branch. If it is a regular documentation set executed, bank cannot now change it to agriculture advance because the sets are different. So just pay little attention to kind of documentation which the bank is making and just correlate that with how the disclosure is made by the bank. These are just additional criteria by going backwards. One more thing, which I just wanted to add over here. It's not really a topic related to that, but I don't know whether any one of you is doing audits of NBFCs. As far as gold loans in NBFCs are concerned, there are altogether different criteria which have got adopted. Because comparatively, these stricter norms are not applicable to NBFCs. So many a times you might find a case wherein certain loans are suddenly taken over by NBFCs in a particular branch. Now, I can talk few things kind of off the record over here, since I know most of you. See, what is happening is that NBFCs are under tremendous pressure at certain point of time to get a particular level of advances. So what they have done in couple of NBFCs is that they have trained their staff at the branch itself to test the gold. Unlike banks, wherein in banks there is an independent valuer is there. Unlike banks, in that there is no independent valuer in many of the NBFCs. So the process of taking over of gold loan is very swift and very quick. So you might come across a scenario wherein suddenly a gold portfolio might have been vanishing in that. One more thing is that you must have gone through the recent news article related to gold loan. Let me give a little background of that. Background in the sense not really related to that, but it's a peculiar issue. In many cases, there are gold loans which just keep on renewing every year. So suddenly after 12 months, that fellow comes over there. Suddenly he pays the entire amount. Again he takes the loan on the same date. Banks also pass the entry of cash received and cash given without any other I should say documentary evidence. Now let's forget about documentary evidence. The issue is that whenever a gold loan is sanctioned, you need to ask first question. Suppose say 10 lakh rupees bullet payment gold loan is sanctioned. The bank should sanction the loan not on the basis of security but on the basis of repayment capacity. That is a fundamental rule, except for advance against FD, wherein you have your own FDs with you. Now in that case, just inquire that in the sanction note whether income will be suddenly generated in the 12th month or not, whether it is specified in the sanction note or not. Because otherwise the intention is clear. After 12 months I have to simply renew that loan itself. It's a evergreening case and that account will be required to be marked as NPA. Because it's a straight case of evergreening. There is no income generation. There is no identified income source. And in most of the cases, if you look at the income level of those borrowers, by any stretch of imagination, they cannot have bullet repayment. So in those cases, you take a conscious call, depending upon what kind of documents are available with you. Secondly, now in most of the banks, there are transparent bags which are used. Never ever get into a scenario wherein you are opening the bag. Means even earlier also it was not supposed to be done, but what I have heard is there are few auditors who insist on opening few of the packets, which is not supposed to be done by us. We can only count number of bags and that's it. If number matches, our job gets over. We are not valuers. And even if we open up open any bag also, we cannot even taste that gold. So let's don't get into that kind of a venture. And whenever the gold loans are renewed, you can just see one more thing. See, typically the gold packets are sealed and the dates are specified over there. Just look at those dates. You might find out a date which is 4 years, 5 years back. And that's a clear-cut evidence available with you wherein evergreening is already done by that particular fellow. And then accordingly you can take a call and say that the accounts are NPA. Because there is no income realization as such. Income is getting realized because gold value is increasing. That is the only source of that. And that should never form a source for income recognition. Then as far as certain categories are concerned, in case of PAX loan or FSS loans, wherein there is an onward lending arrangement, it will be the account of the portion of NPA will be marked purely on the basis of the subsequent credits which are extended by FSS and PAX. For that, those accounts should be made available to your branch. Means suppose you are having a PAX loan, suppose 100 loans are subsequently given by PAX. Those 100 loan account statements should be available with you. Then only you can monitor these things. Otherwise, it's only a guesswork that on the overall basis there is no overdue. That criteria should never apply. LCBD we already discussed about that. Then in consortium advances, it might happen that with couple of member banks the account might be PA. With others the account might be a standard NP account, because every member bank will decide based on their own record of recovery. Straightaway classification norm we already discussed in brief about that 50% erosion. And one more norm is there, that wherever in case of secured loan, if you are having underlying security value which is less than 10% of your ledger outstanding balance, the account will be required to be turned into a loss asset category. So first one is about 50% erosion, there the doubtful asset category is defined. Second one is less than 10% security value, then your account will turn into a loss asset category. Now what RBI specified for standard account is, if erosion is happening, then for standard account, the bank is supposed to probe into the reasons why that erosion has occurred and then take a conscious call. As far as we as an auditor is concerned, just inquire that how the system is handling this 50% erosion. Now let me tell you my own experience about how the CBS handles. CBS doesn't identify between erosion of security, replacement of security and release of security. So let's take an example. Suppose A is the security with 10 crore value, amount outstanding is 1 crore. So the borrower has requested the bank to replace that A security with B security. So B security might be of say 4 crore, which is accepted. System will never recognize that whether that security erosion is there or whether there is a replacement of security is there. That identification is not there in the system. That is first thing. Second thing is that almost all CBS don't mark any standard account as doubtful asset account because of erosion. They only turn substandard accounts into doubtful. And they don't have any MIS wherein you will get a list of standard accounts wherein there is a erosion beyond 50%. So inquire with them as to how the MIS can be made available to you. If the MIS is not available, you can make a disclaimer by saying that these things are not identifiable. Let's take a complex case. Suppose ABC, 3 securities are there. And values are say 10, 5 and say 25. So total is 40. Now suppose 25 securities removed, it is not erosion. There is a NOC given for say sale of that security. That cannot be quantified as erosion. And erosion is taking all securities together. It is not a standalone case. So suppose only A is, there is a erosion of say 60%, it doesn't mean that the account should be doubtful. ABC combined there has to be erosion. So it's not a straight and simple criteria. In most probable cases, it will be manually controlled. But just inquire about the standard asset instances. As far as fraud related accounts are concerned, if the fraud is reported to RBI, staggering for 4 quarters is possible. If the fraud is not reported, then you have to make 100% provision. Then the subjective criteria which we talked about related to inherent weakness. Now as an auditor, if you are certain that there is a inherent weakness, you have to simply convey your decision to the branch manager. If you are little uncertain also, then you need to ask the branch manager to give a representation letter to you. You can ask him that under what circumstances he presumes that there is no inherent weakness. So take a kind of a negative confirmation justification. Now whenever you are getting a representation or justification, it doesn't mean that you need to accept that. It is only a representation given to you. You need to take your call as a professional judgment, because here your professional judgment is required. But don't get into a loop wherein you will say that all accounts are having inherent weakness. Don't get into that. That is something which is ideally is not supposed to be done. So go on case to case basis, build up the reasons for that, convey those reasons and then mark that account as NPA. Now as far as inherent weakness examples are concerned, I have just jotted down few. See, at times what will happen is the accounts might have been regularized, but the source of fund will be entirely different from a regular business. Like suppose fixed assets are sold, a major portion of fixed asset is sold. You cannot say that the account is good. There is an inherent weakness. He is required to sell off his assets and pay to the bank. So naturally there is no income generation activity which will take care of the requirement which are there for repayment. At times the promoters might be infusing the funds. On year basis he is infusing the fund. There is a loss which is incurred but the account is regular. Now this is not income generation activity. Collaterals might be sold off. And most controversial, or I should say argumentative cases, he might liquidate the FD and say that FDs are liquidated, my account is normal. But out of liquidation, if someone is nullifying the overdues, it doesn't mean that that will justify in long run. He may not be having that kind of FDs with him. And if he is having that kind of FDs, he will never take loan from bank. So that's where you need to match it. Again, you need to go by materiality also. If certain small component is taken care by all these things, it is fine. But see that what is the major source. If major source is out of business, the account can be standard. As far as mandatory valuation norms are concerned, the mandatory norms are applicable only for NPAs where the exposure is above 5 crores. And for others, it is non-mandatory. Mandatory norms are for stock statements. Once in a year, independent stock audit has to be there. For immovable property, the government approved valuation has to be there. Now what you can take a call as an auditor is, again on a case to case basis, if such valuations are not available, you need not have to go by the earlier valuations. Maybe a valuation is there which is 5 years old. You can take a conscious call by deciding as to whether you are comfortable with earlier valuation or whether you want to take it as a nil value. Both options are available with you. But be more careful about the movable assets, because in case of movable asset, there is no valuation norm which is required. So let's take an example of a vehicle loan. Now the security value which might be fed into that system might be the invoice value, maybe 3 years back invoice. That cannot be today's security value. So there has to be a consistent practice wherein you need to depreciate that. And what is consistent is something which you can judge, on the basis of how it is followed by the branch. Then let's come to the projects under implementation. I will quickly cover this up because it has more to do with DCCO rather than any other criteria. Otherwise, these loans are normal loans. Only remember one thing, in project loans, essentially these are term loans. Because once you give CCOD, it means that the commercial operation has started off. So while granting project loans, CCOD might be sanctioned, but it will not get disbursed unless and until the production is starting off. Now in case of these project loans, what is required to be defined is date of completion and date of commencement of commercial operation. That is DC and DCCO, both are required. Type of project loans, they are divided into infra and non-infra, and based on that there are certain concessions are there. So there are 3-4 concessions are there. We'll just look at each concessions one by one. First one is that it might happen that you have given a project loan, but subsequently the project outlay has changed. So suppose earlier 100-bed hospital was there, and now they are building 150-bed hospital. So if the project outlay is going beyond 25% increase, then you can entirely restructure the loan. You can give additional funding, change the entire, entirely reschedule the installments. Still account will remain into standard asset category. But if it is below 25%, the account will be presumed to be restructured, and then the account downgrading will happen. Now this 25% will not include any cost overrun. But there might be instances wherein technology changes might occur and production facilities might increase beyond 25%, which is permitted. Then extension of DCCO. In normal case, revision in DCCO is permitted to the extent of 2 years for infra, 1 year for non-infra. For this, no reason is required. A mere application from borrower is sufficient to extend the DCCO, and to that extent, you can extend the repayment schedule. If you go beyond these 2 years, it is a restructuring. So downgrade the account. Then if there is a court case, additional 2 years are given for infra, and if there is any other reason, like say government funds are not given, or some natural calamity has happened, additional 1 year is there, so 2 plus 1. For non-infra, it will be 1 plus 1. That is maximum 2 years extension is possible. Then there are certain other conditions are given for CRE section. So for CRE, 1 year extension is permitted. Now this benefit is available only for commercial banks. This benefit is not applicable for UCBs. For UCBs, other criteria is also different. Let's not get into that. But CRE, there is a specific thing that CRE DCCO extension concept is only in commercial bank, not in UCBs. Then one more leverage is given wherein there is a change of ownership. So suppose the ownership or the management has changed because the existing management is not able to perform and complete the project, and if the new management is out of the group, that is, it is not within the group company, then additional 2 years are there. So for infra, practically you can get 6 years. 2 years original, 2 years court case, 2 years ownership change. So that is a maximum cap to which DCCO can be extended. If any of these caps are breached, the account will be downgraded by presuming that it is a restructuring process. Then as far as financing of cost overrun is concerned, RBI has given a leverage that to the extent of 10%, either the bank can pre-sanction or on a case-to-case basis, whenever required, that 10% can be given, and that will not be construed as restructuring, even if that 10% is given. As far as income recognition is concerned, we have covered most of the things, but let me just reiterate that for all standard accounts, the income recognition will be on accrual basis. For all NP accounts, it will be always on realization basis. Now let's get into little controversial topics so that it becomes more interesting. For commercial banks, it might happen that in case of a NP account, there is a listed security which is given. So in that case, whenever the security is transferred in the name of the bank, on that date, whatever is the value of that, fair market value or market value of that security is there, that is presumed to be realized. And that asset will become a banking asset as an investment product. Now let's look little beyond that. So this is a concept wherein realization in kind is permitted, right? Because I am not receiving cash, I am receiving a security. Now let's look at non-banking asset. As all of you are aware about that, non-banking asset is permissible to be created under BR Act. There is no RBI circular about that. Under BR Act, only immovable properties can be created as a non-banking asset. So always remember one thing, bank cannot transfer any borrower's asset in its name as a non-banking asset, except immovable property. So suppose there is a vehicle loan, bank cannot transfer a vehicle loan as a non-banking asset. It can acquire as a banking asset. Now when you are talking about non-banking asset, RBI doesn't specify about the accounting treatment. So non-banking asset is a kind of realization in kind, right? Because it is a immovable property which is transferred in the bank's name. Risk and rewards also are passed on to the bank. Prudent practice is that since RBI is silent on that, non-banking asset should not be treated at par with security. The reason is that security which is marketable and a non-banking asset which is a immovable property, there is a huge difference in that. Because instant realization is not possible. There is no market. Now for that, how the accounting should be done is, suppose your NP account is turned into a non-banking asset. Let's take an example, 100 rupees is ledger balance, 20 rupees is IR/OIR, and say 50 rupees is BDDR. You have acquired an asset of 120 rupees. So you have given no use letter to that borrower also, because the entire amount is realized. But for you as a bank, 120 rupees are yet to be realized. You have only acquired as a stopgap arrangement. It's a in-between arrangement. So when you acquire that asset at 120 rupees, your accounting will not be for 120, it should be net book value, which is only 50 rupees. Because 20 rupees is contra IR/OIR, 100 rupees is ledger, 50 rupees is BDDR, so net book value is 50. Whenever you sell off that non-banking asset at whatever value, say 130 rupees, 50 and 130 difference will go to your P&L account, because risk and rewards are passed on to you. If it is realized at 90 rupees, 50 and 90, 40 rupees will be your profit. But that's where RBI circular is not really clear, because if you read the circular, it talks about realization. It doesn't talk about realization in cash. That cash word is missing. But again, that is a loophole. We are not bankers, so we should not get into that. We should stick to conservative principle. Guidance note includes this concept, but it includes about presuming that the non-banking asset should be booked on a conservative basis. In fact, if you look at the bigger banks' notes on accounts also, they are also sticking to the point that it will be net book value. Now let me go a little further. Once you have non-banking asset, it is not your fixed asset. It is your other asset. So depreciation doesn't apply to that. But what the bank is supposed to do is, they need to revisit that value and see that there is no deterioration. So valuation is required at not so frequently, but maybe alternate year or once in 3 years, just to ensure that value is not deteriorated. Now this is something which may not be applicable to the branch, but I just thought that I should share this concept with all of you. Can I take 5 more minutes? Ketan is a very close friend of mine, so I can take that liberty with him. Okay, then order of recovery. As far as standard accounts are concerned, and NP accounts are concerned. Now RBI circular talks only about NPAs. It doesn't talk about standard accounts. Now let me correlate from where I am coming. So let's first talk about NPA. For NPA, what RBI is saying is, bank has to decide its policy as to how the order of recovery should be. Most of the banks, what they do, out of realization, first they will realize unrealized expenses, commission, legal charges, postage. So charges they will first recover, then they will go to unrealized interest. At the end, they will come to principal outstanding. This will be breached only in case of settlement accounts, wherein the order of recovery might be different on a contractual term. So this is what most of the banks do. There are few banks, what they do is, for substandard there is a different flow, for doubtful there is a different flow. But that has to be specifically stated in their accounting policy. So that is as far as NP is concerned. So NP RBI has said that it is a bank's prerogative. It is a discretion of the bank. Now let's come to the PA. PA RBI doesn't say like that. So PA, it is presumed that normal accounting should prevail. Now let me just correlate that with demand satisfaction. So demand satisfaction is not really an order of recovery, because the account is PA. There is nothing like recovery, which is getting hit to your realization. So their normal realization concept will prevail. So don't, mix up NPA related portion with PA. Now let's, for the sake of argument, let's presume that the bank argues that we will go by demand dates. So first 1,000 interest, then 9,000 principal, like that. Just ask them one simple question, whether you have disclosed this in your accounting policy or not. Because none of the bank discloses this. If you really want to go by the demand chart, first interest principal, like that, you have to disclose that, because it is totally deviating from normal accounting. And RBI Circular per se doesn't talk about that. It talks only about NPA recoveries. Then as far as certain practical aspects are concerned, there are few issues in couple of CBS systems. Interest reversal is comparatively common. It is working well, though not exactly in accounting terms, but at least interest is reversed, which is not realized. But if you look at the bank charges, commissions, discounts, legal charges which are debited in the account prior to date of NPA, those charges typically are not getting reversed. So pay little attention to those accounts which are marked as NPA during your tenure. Now secondly, whenever account is marked as NPA, subsequently interest shouldn't be debited in that account. That's what the circular says. Now compare that with your CBS system. The CBS system, if you look at the ledger, the accounts are debited in that. Income is not recognized. But RBI circular wording, if you look at it, it doesn't say that it should be debited. Rather, it says that it should go to memorandum account, which doesn't happen. Anyway, it is not affecting your profit and loss per se. But if you go strictly by the circular is not exactly what CBS systems are doing. That's where I will just refer to that para. Para 3.4 is talking about memorandum account, and memorandum account by any stage of imagination cannot be your actual ledger account. It is a kind of a shadow account which one has to maintain. But shadow account concept is not there in CBS. So it is main account only wherein interest gets debited. Against that provision is made. So income is not recognized, but it's not strictly as per para 3.4. Then as far as provisions are concerned, standard accounts have a provision, will come to that. Once the account is marked as substandard, for 12 months it will remain into substandard asset category. Loss asset at any point of time, either statutory auditor, bank or RBI inspector can mark any account as a loss account wherever he is doubtful about the recovery against that. Then after substandard 12 months, next 1 year it will be under DA1, then 2 years DA2, then DA3. Standard asset provisions, they have remained same. My suggestion is that whichever account you are picking up on a random basis for verification, just ensure that categorization of that account in the master data is correct or not. Like for example, if it is a CRE loan, whether that CRE loan is a commercial real estate loan or whether it is a residential housing project, because based on that your percentage changes. So at least pay attention to master data to those accounts which you have picked up for test cases, because you might be picking up test case maybe 10 accounts, 20 accounts, 25 accounts. So just look at that angle also, that the provision is correctly done for even for standard accounts. Then substandard accounts, as far as secured loans are concerned, 15% is the provision. For unsecured, 25%. If it is an infra loan backed by escrow facility, 20%. Now while substandard account provisioning, it should not have any concession factored in related to ECGC or similar covers which are available to the account. Now let me just go deeper into that. We were talking about the DA1 and DA2 category. So I will go a step further. So let's presume that you are having a DA1 account wherein the security value is say 80% coverage is there. So out of 80% you need to provide 25% because that is a secured component. And for unsecured you have to make 100% provision. Now wherever there is a ECGC and CGTMEC or any similar covers are there, to that extent you are not required to make any provision. But that concession is not there for substandard. Substandard it is flat provision 15%. Once it gets into DA1 category, that concession is extended. So just remember this point, back of your mind. Then country-wise exposure norms, these are typically taken care of at head office level. Then provisions under special circumstances. So as far as these accounts are concerned, which are covered by CGTMSC or similar schemes, just refer to the IRAC circular. They have given a good example about how to make a provision of that. So suppose 100 rupees is my account value, how that CGTMSC cover is reduced and how that balance amount is only required to be provided for. That example is already there in IRAC circular. So just see that whether the flow is correctly captured or not. Because first the security value and then CGTMSC cover is factored in and not vice versa. Then takeout finance is a typical case wherein there is a pre-agreement between different banks to take over that account after a completion of certain period. So that gets continued with the same asset classification. So if in say bank A, loan is taken over by bank B, bank A is already classified as substandard, substandard classification continues. Then post-shipment suppliers credit, if it is backed by Exim bank guarantee, the guarantee claims are settled in 30 days. So as an auditor, you need to verify that in such cases whether the claims are lodged or not. Export project finance, if there is an export which is made to a country wherein there might be a restriction in that country for outward remittances, then in that case, that borrower can open an account in that particular country, receive that money in his own name, and then 1 year extension is possible. But that account opening and taking money in its own name is required. Otherwise, 1 year extension is not possible. Now, as far as restructuring is concerned, restructuring terms are fairly simple now as compared to earlier one. There is nothing like concession which is possible. So the simple term is that you can do restructuring for any type of account. Whether it is a standard, NPA, it doesn't matter. Only accounts which are having a fraud element involved in that, these accounts are not allowed to be restructured. But let me just add one more point. Recently, RBI circular has been issued about one-time settlement and compromise settlement, wherein fraud accounts can also be settled subject to continuance of that court case. So, it's a little dicey, but that's what RBI has permitted, so that at least certain funds will be received. Now, whenever you restructure an account, it can be at any phase, before commencement of commercial production, after that account turns into NPA. So at any life cycle, you can restructure the account. Now, what is the definition of restructuring? Restructuring means if you extend any economic benefit, or to put it in simple terms, any concession which is only for a particular borrower account and which has nothing to do with market competition, then only the account will be said as restructuring. So let me give you a simple example. So let's presume that there is a CC facility. You turn that CC facility into a term loan. This is not a concession. It's a prepayment actually, as compared to CC. So it is not restructuring. But if term loan is converted into a CCOD, it is a restructuring process. Or ballooning is done. Or maybe, tenure is extended, interest concession is given. All these are examples of restructuring. Now the criteria is that standard account will be downgraded to substandard account. That is the first thing. If an NPA account is restructured, the earlier norms, 2 years back, the norm was that even NPA downgrading was there, which has been removed. So if substandard is restructured, it remains into substandard category. It doesn't fall into DA1 category. But for standard, it will go to substandard. Additional finance is possible, that will remain into standard asset category for 1 year. And all accounts will be eligible for upgradation, provided that there is a satisfactory performance which is displayed. Now for satisfactory performance, there are 3 criteria. One is that for MSMEs, which are having an exposure up to 25, that is less than 25 crores. So in that tenure of 1 year, that 1 year tenure will start from commencement of first payment. There should not be any component which is overdue beyond 30 days. So that's the criteria. For loans which are having exposures above 100 crores, additional criteria is there that it should be at investable grade. And for others, that is those who are not MSME or MSMEs above 25 crores exposure, then in that case, there should not be any default. So there is no 30 days concession, not a single rupee default should be there. And the period of that tenure will be 1 year or 10% of repayment, whichever is later. So that's how the criteria are defined for satisfactory performance. Now one more thing is that in case of satisfactory performance, if you remember earlier that sacrifice ratio calculation was there. A few of you might be remembering that is no more applicable for commercial banks. That concept still remains in UCBs. Here the concept is removed. So no Excel worksheet and NPV valuation is required. Normal provisions are required. Then wherever there is a failed satisfactory performance is there, then in that case, there might be instance that there might be a change of ownership. So in that case, you can again go for restructuring, or under IBC you can proceed, or you can have a fresh restructuring implemented, subsequent to that. Provisioning requirement, as we discussed, normal provisioning norms are there. Accounts under resolution plan, there are different criteria are there. Then early identification and reporting of stress, SMA 0, SMA 1, SMA 2. So SMA 0, 1, 2 is applicable only for term loans, and for CCOD accounts it is only SMA 1 and SMA 2. In most of the CBS systems, SMA 0 marking is also done for CCOD. So just inquire that it is whether it is only for MIS or it is for reporting also, and how the relational accounts are taken care of. Like for example, if there is a SMA 0 CCOD account and term loan is not overdue, term loan is exactly regular, whether the term loan is also getting classified as SMA 0 or not, that is the point which you need to check it up. Credit reporting, as all of you are aware about that, credit reporting is main report goes on a monthly basis, and there is a weekly reporting, every Friday reporting for accounts which are above 5 crores. Now there is a kind of loophole over here. Suppose your account is having 10th as installment due date, account turns into NPA on 10th, but gets regularized on 25th. Account is below 5 crore. This lacuna will never get reported anywhere because CIBIL reporting is month end, credit is weekly, CIBIL is monthly. So in between the month, if there is any account which turns into NPA and gets out of NPA, there is no reporting criteria. It will remain as a standard asset category account. Then as far as this prudential framework for resolution of stress asset is concerned, this practically doesn't apply to almost all of us. The reason being, the first, when it was launched actually, it was for accounts which are having 2,000 crores and above exposures. Then RBI came out with guideline wherein 1,500 and 2,000 crore accounts were covered from 1st January 2020. Then they said that up to 1,500 crores they will come out with date of implementation, which still that date has not been notified. So rarely we will get an instance wherein it is more than 1,500 crores. I have included that in PPT, but I will not get deeper into that because it's rarely applicable. So if any one of you comes across that, we can just review that. I will just come to the end by adding couple of points. So there are a few things which you need to keep in mind. First important factor is that except this circular, in all other circulars, there is no mention of responsibility of auditor. In the sense, circulars are applicable only to the banks, not to the auditors. They are not addressed to the auditors. So they are not mandatory on us. We are there only to check that. But for this circular, RBI is saying that provisioning responsibilities of banker as well as auditor. So be little vigilant about IRAC circular. In other cases, we can say that it was for the bankers to read and not to us. They have not addressed it to us except this, because there is a specific mention. Second thing is that if the bank is not making adequate provision and if the auditor decides to qualify the report, the repercussion is that the bank is not able to declare a dividend. So the moment if you qualify your report, even at the branch level, unless central auditor drops your report, which is never done, even though there is a popular myth that central auditors just remove all the qualification, that is not the reality. If you have qualified the report, qualified report is never overlooked by any central auditor, because then it becomes his onus to prove before all the authorities that why he has removed that. So no one does that. So that is a power which you are having. You need to use it diligently. It's not the other way around. And last but not the least, just ensure that you are not compromising on your independence. See, anyway, whenever you are getting a bank branch audit, it's by sheer luck factor, to be very honest. Now, luck factor, why I am saying is that because we are presuming that, we will be getting that as a kind of, because we are CAs, we should get that audit. Such kind of monopolies may not exist. So let's presume that it is one of our client and not the sole client which we are having. Anyway, I presume that, none of us is here who is solely dependent upon bank audit, right? So, don't presume that, the same scenario will occur again. So, maintain your independence. Once you complete 4 years, those who have appointed you will never be there to appoint you again, because at least there is a gap of one gap is always there. So, even if you want to go to the same bank and so-called, you want to maintain your relation, there is nothing like that. Once you are not an auditor of that bank, no one will recognize you, right from central auditor till branch auditor. So, better that we maintain our dignity and independence, don't compromise on that, and there is no reward for skipping a particular point. It's the other way around. There are different kind of rewards, negative rewards, I should say, that which are there. And last but not the least, all standards are mandatory for us, including standards for auditing. Just pay attention that standards for auditing are complied by you. I'm not saying that you need to have, too exhaustive documentation. Even I know that there are limitations on that, but ensure that you can demonstrate that this particular standard is complied by you. Secondly, as far as guidance note is concerned, guidance note, if you comply, you don't have to do any further documentation. There cannot be any disciplinary case against you if you have followed the guidance note. But if you don't follow the guidance note, if you decide to deviate from the guidance note, you need to prove yourself as to why you have decided to deviate from the guidance note. And this is not the case with any other publication. So stick to guidance note. There might be n number of WhatsApp messages, YouTube, videos, but just, compare that with what guidance note is saying. And last thing which I want to say is guidance note don't go by that number of pages actually. All of you are expert and guidance note is a reference material. It is not a textbook for first standard and second standard, wherein from first page till 800 page you have to read. No one is required to do that actually. It is a reference material, use that diligently. All of you know bank audits. It's not that someone is doing bank audit for the first time without knowing the industry. And if you're doing that, anyway you are violating SQC1. That you don't have your expertise and you are doing a particular audit. So when you are accepting the audit assignment, it is presumed that you are aware about that industry. So once you are aware about the industry, reference book is more than sufficient. So use that guidance note diligently. And again, all the best to all of you for continuing auditors, and those who are not there, they will become continuing auditor. And thanks, and thank you once again to all from Ahmedabad branch and all of you. It has been always a pleasure to interact with you. Thank you.
It's always a pleasure to listen to you, sir. The faculty of the session, C. Dhananjay Bhai, my council colleague, C. Hitesh Bhai Pomal, C. Ketan Bhai Sayya, colleague plus faculty, C. Rinkesh Bhai, Saxena sir, the faculty of the first session, and friends, good evening all of you. It's always said, because if I just look at the old, very old days, અને હંમેશા એવું કહેવાય કે બેંકમાં જે સ્ટેટમેન્ટમાં લખ્યું ને it is final. And if I identify there is some difference before we do bank audit, we always believe, sir, bank statement is always correct. The way they do interest calculation is always correct. If I find something is different, it's my mistake. That's what I used to believe before doing bank audit. And today, you have said and very clearly that everything we have to challenge. We can't rely on anything. Starting from the terms, installment terms in the bank system, is it correct or not? Thereafter, computation of overdue amount. Thereafter, computation of PA and PA, security valuation. So that means at the end of this session, it seems that our responsibility has been very high. We cannot blindly rely on the system. We should have a collection of samples from every different class of assets, advances. And for every different class of assets, advances, we need to have a sample selections. And for every sample selections, we should look at the how system functions, how the system gives valuation, how the system gives reports, and that has to be compared with our own calculation, then only we can see it's correctly done. Thank you so much, sir, for opening the eyes. Obviously, the IREC has been one of the very, very important things for all of us, and when he mentioned that specific mention of the auditor is there in the circular itself, so that there is increased responsibility on our shoulder. And as I mentioned earlier, that you all are the persons who will ensure that in future, if you want a number of audits of bank higher, we have to ensure that our documentation, the way we do reporting, has to be perfectly done. Once again, thank you so much for coming here. And sir, without our bank audit seminar cannot be completed without listening to IREC and you. So thank you. Once again, have a big round of applause for him. Now taking not much time further, we can have a change of dais and immediately we'll start over. Thank you once again.